Welcome to the BIS Annual Conference webinar. This is the fourth in the series of webinars that we've had so far, and it's a great way to close out the year. My name is Hyun-Song Shin, and it's my pleasure to be hosting today's session. Today, we're very happy to have Matteo Maggiori as our speaker, and we have a really great lineup. We have Linda Tesar and Laura Alfaro as our discussants. Now, Matteo is well known to all of us. He's one of the most insightful researchers in international finance. And his work is characterized by a very keen eye on tackling questions that shed light on the big policy issues of the day. And today's talk is no exception. He's going to tackle the big issue of FX policy and the role of exchange rates in both the macroeconomic impact, but also the financial impact as well. And there are some very big policy issues that he'll be tackling in his presentation. The title of his presentation is FX Policy When Financial Markets are imperfect. I think you'll see that this presentation really touches on the very lively debate that's out there on the macro and financial policy frameworks where monetary policy and policies towards financial stability have their meeting points. So let me, without further ado, turn to Matteo. Matteo, the floor is yours. Welcome.
Thank you so much, Tun, for having me here. It's a great pleasure to give the concluding talk of the annual research conference of the BIS. And thank you so much for the kind invitation and the kind introductory remark. Thanks also to Laura and Linda for being available to be discussants and to have a panel with us. I don't think today I need to introduce this policy topic quite as much as on any given day, because if you open the Financial Times this morning, if you open the financial press, you will have noticed that the US accused Switzerland of being a currency manipulator. And much of that had to do with Switzerland intervening heavily in the FX market over time. So these are big issues of our days. Countries are doing it. We need to understand why, what are the risks, what are the good and bad things for the countries that are doing it and for their neighbors. And today we're going to get a little bit into this. Where do we start? I would say in the last 15 years, we've seen three very big crises in rapid successions. These are supposed to be things that happen very rarely. If you're an economist of my generation, pretty much all your entire career, you've seen a crisis of fairly big size every 3 or 4 years. So we've had the global financial crisis, we've had the European sovereign debt crisis, and now we're still going through the COVID-19 pandemic. These crises have pushed interest rates against the zero lower bound, giving relatively little scope for traditional monetary policy, the way we normally would confront these episodes. And that has put policymakers and academics in a position to rethink about a broader set of tools that sometimes have been used in the past, sometimes not as much, but certainly not in a systematic way, in the way we're using them now. So the most obvious is perhaps domestic quantitative easing, central banks buying domestic assets to affect credit. Another one, which is the one we're going to focus on today, is the foreign exchange intervention, where you're buying foreign currency assets while selling domestic currency assets to sterilize, or vice versa. Capital controls, putting some form of taxes or wedges on the returns of capital to foreigners domestically. Or, of course, negative interest rates, trying to make that zero lower bound not quite at zero, but giving yourself some extra margin. This, I think, has been one very big active area of macroeconomics, trying to think about these big questions and what it is that we can do to improve their usage. If I look at what we're going to do today, I'm going to provide a very, very brief history of FX intervention as a policy. Many of you know this history. I will then play around with a very simple policy framework. I think one of the things that economists, I believe, over the last 10 or 15 years have been good at is providing simple frameworks to policymakers to start understanding these policies. How do I think about QE? How do I think about FX intervention? How do I think about capital controls? What is their role combined? And so we'll play around with one such framework. And then towards the end, I'll take it to a more speculative place where I'm just going to give you my thoughts on the policy. Some of them come from the model, some of them come from observation. I will talk about the data, although that's where, I would say so far we have the least to say because we haven't been able, as a field, I think, to make quite as much progress as we would like. And then we'll talk about some remaining challenges. So if I take a step back and I think about FX intervention, I would say it's always been heavily used by emerging economies. And in a class of models, it's thought to be ineffective. What is the reason why in many models it has no effect? It's not like good or bad, it just does nothing. It's a combination of Modigliani and Miller logic applied to a central bank and Ricardian equivalence. The way to think about this is if the Swiss central bank buys a lot of euros, the Swiss residents understand that they're ultimately doing it on their behalf. Because if the central bank makes money on this position, they'll have to rebate it somehow. If the central bank loses money, some other nation will have to come up either to taxes on inflation on a way to absorb the loss. And so if you don't like what they're doing, you can simply take the other side. And therefore, at the country level, nothing really happens. That's the Modigliani-Miller part. And the Ricardian equivalence part has to do with the losses, the potential losses and gains of the FX intervention not having an impact on actions because the government is simply a pass-through entity. And so Ricardian equivalence holds. Now, you can see that this, while it might be an interesting benchmark, theoretically, it's not one that we would think holds in practice. And yet, for many years, this was sort of used as a bit of a practical prescription rather than a theoretical benchmark. Early empirical investigations of FX intervention found very inconclusive evidence. When I look at them today, I would say that there are two big things that I will return to. One is little data. And I don't mean little just in terms of the quantity of data. It's also that the interventions were really, really small. And as I will sort of try to elucidate through the theory, the size of the intervention is something that I think we need to take a little bit more seriously when we confront the data. And of course, there is obvious endogeneity problem. If my currency is appreciating and I'm trying to intervene to fight the appreciation, maybe all I do is I slow it down. That's a policy success. But if I simply run how much did I intervene on changes on exchange rate, it will look like the opposite result. It will look like I'm causing an appreciation by intervening. And it's just clearly, I'm sort of mixing it up by not understanding the reverse causality. That's where all the literature was. Now, recently, FX intervention has been used on a very grand scale. So here I'm looking at the Swiss case. In blue, I have the FX reserves of the Swiss National Bank. And in orange, I have Euro-Swiss. The blue line is on the left axis. So Switzerland, in a period between 2009 and 2020, went from having just under 15% of FX reserves over GDP to accumulating reserves very quickly. You see it happens in a period where the Swiss franc is appreciating strongly against the euro. They then impose a floor on Euro-Swiss. They kept it for a while, and then you all remember the famous event when they let the floor go, and they kept intervening and accumulating a lot of reserves. And here I have a quote, a very recent one from Governor Jordan, who says, "Interventions in the foreign exchange market play a central role in our policy mix." And the talk was actually given at the IMF, which, if you know the history of the IMF, you will find it to be quite a change from previous years, as I will remark on in a second. But Switzerland is not alone. Here is Israel. Israel has gone through two big bouts of intervention on the shekel. One is the early period during the global financial crisis, or the aftermath, 2009 to 11. You can see the shekel is appreciating, and Israel is intervening heavily. Then the appreciation stops. There is no intervention for a period. There is a lull. And then the appreciation resumes, and then been intervening in and out. And again, here's a quote from Stan Fischer, who at the time was the governor of the Central Bank of Israel. "I have no doubt that the massive purchases of foreign exchange we made between July 2008 and 2010 had a serious effect on the exchange rate, but which presumably means not appreciating as much, which I think is part of the reason that we succeeded in having a relatively short recession." So you can see again and again from policymakers a conviction that this intervention is doing something, that it is a useful policy tool. Here's the case of the Czech Republic. They first imposed a floor against the euro. They intervened to move the currency above the floor. For a while, the floor wasn't tested. There is no intervention. And then towards 2016, 15, 16, the currency starts to appreciate. It gets against the floor, and the central bank starts intervening. As the flows get bigger and bigger, the currency is tight against the floor. The central bank is intervening more and more. And then you can see, very much like Switzerland, they eventually let it go. And here it's not to tell you whether these interventions were successful, were done, costly. This is more to say this policy is very heavily used. And that means we have to understand, and there's a bit of a gap between the policy use of FX intervention and how we think of them in models. And so the talk today is trying to make the two speak to each other, at least as much as I can do so. The consensus has recently changed. I would say that Switzerland, Israel, the Czech Republic are a form of the new consensus. Traditionally, as I mentioned, the Washington institutions, in particular the IMF, had not viewed kindly FX intervention or capital controls. And in the period post-financial crisis, the IMF has gone through a major rethink of their policy advice. Capital controls and FX intervention are now more of that. And the BIS, for example, has been a huge contributor to this in sort of taking an interesting view of financial markets and how they work and trying to create a new policy framework, particularly for emerging economies. On the theory side, recent theoretical frameworks have looked at how we think of exchange rates once financial markets are imperfect. And once you break the perfect financial markets, all of a sudden FX intervention with market segmentation becomes effective in a natural way. And you can ask more questions. You can ask, well, even then, is it a good or a bad idea from a welfare perspective? How do you use it optimally? And I think that that's important. Here I mentioned the BIS, who has been a leader in sort of thinking about new ways to approach the policy framework for emerging economies. And here's from your annual report of last year, where they mentioned whether such FX intervention and accompanied by policy rate changes can affect exchange rates has long been questioned. That's sort of where we come from, as I mentioned. But recent theoretical contributions have shown it can be effective under realistic assumptions about the functioning of financial markets. And the empirical evidence is consistent with these results. So you can see, how the policy institutions over time have reacted to new evidence, new models, and their own thinking, trying to move us along. The IMF has just put out an integrated policy framework. They're trying to revise their own models, and there's a new role for FXI that comes along similar lines. So it's an open conversation where we're all trying to make progress to lead to better policies. For the next 10, 15 minutes, I'll take a look at what the policies are. And in particular, I'll give you a very simple policy framework. Now, there's going to be a few questions, a few Greek letters. If you're, particularly for those of you that are watching on YouTube, if that's not your thing, just listen to my words. We're going to try to make it very concrete in a way that is more like a mental framework than it is a set of equations. But the way I think about this is, we want capital flows to alter the balance sheet of financiers. If somebody wakes up and they're trying to buy an enormous amount of Swiss francs, perhaps because of a flight to safety, they're approaching a bank like UBS or Credit Suisse, they have to take the other side. Now, the financiers, even if they're big, the flows are also very big. And so they're using some of their risk-bearing capacity. And in equilibrium, they need to make money. If you're asking Credit Suisse to be very short Swiss francs because the European institutions want them, Credit Suisse is going to think of it as, do I want to do that? How much money do I make in equilibrium? And if there's a lot of demand to get hold of Swiss francs, what will happen is the Swiss franc will appreciate, so much so that in equilibrium, as we emerge, for example, from a crisis, it will depreciate, making it profitable for Credit Suisse on average to hold the other side of the trade. So it's a very simple, I would say, financial press rendition of how exchange rate works. It's surprisingly complicated to make it stick in a theory model. Even if the logic seems so rather obvious. And we're going to try to do that in a second. Here's how I'm going to do it. I'm going to elect Yoon to be my US household. I'm going to take Linda to be my Japanese household, and they're going to trade goods with each other. That's a very standard thing in economics. There's reasons why we trade in a goods market, because we produce different things. But normally what we do is we make Linda and Yoon face each other also in perfect financial markets. And here we're going to take that one away. We're going to say that both Linda and Yoon face Laura, who's my financier, and they trade bonds in different currencies with Laura. So the way we want to think of this market, if I think of the world out there, is the FX market is very concentrated in a few large players, like Goldman, PIMCO, the big banks and asset managers. It's not a market for households, and it's their balance sheet that pins down exchange rates. And so we're going to make it have a role. So that's all you have to remember about the framework. Now the rest is making sure that everything I just said, in some sense, is correct and sticks around under some assumptions. And we're going to sort of look at it together. And this is really with my wonderful co-author, Xavier Gabex, who's a professor at Harvard. I'm just going to review a little model that we have together. So, if you like it, you really should think of it as a joint credit with Xavier. I'm going to start in a world where there's only two periods. There's today and tomorrow. And there's, Yoon and Linda, US and Japan. They trade goods with each other. They like non-tradable goods. Those are, sushi in Japan and burgers in the US. And they also trade tradable goods. They have cars that they ship to each other because they like each other's new models of cars. And that's all there is. And then we're going to make it very simple. We're going to say that each of them can trade a bond. So there's one bond that is risk-free, like a US Treasury, and there's one bond that pays in yen. Okay, very, very simple. They want to lend and borrow in these currencies to smooth their consumption over time. This is the part where there's many letters. But the only thing that you have to remember about it is that this is Yoon trying to figure out how much does he wants to consume today and tomorrow, and whether he wants to spend his money on his domestic good, on the goods that Linda produces, and so on. So it's a very standard way in which we do things in economic theory. We just think about simple problems that capture the reality of the world of people trying to consume different goods. And Linda will solve a very simple, identical problem. Now, the only thing that it's useful to think about is how much does Yoon want to import from Linda? The way to think about this is this little parameter iota governs how much Yoon likes goods produced by Linda. The more he likes them, the more he will import them. Of course, the problem is that he has to pay for them. So the higher the price of these goods, the less he will want to import them. And you really want to think about FX policy as affecting what price Yoon faces for those goods. The exchange rate just simply moves around in a well-defined way the relative attractiveness of foreign consumption versus domestic consumption. If, for example, you're a European and you're trying to import something in the US, and that something is priced in dollars and the dollar appreciates, that's going to be more expensive for you. So for economists, that's what we call the exchange rate expenditure switching effect. It goes all the way to Keynes, and it tells us that we believe that if you depreciate your currency, there might be advantages to your economy because you might be able to export more as your goods get cheaper on the world markets. And that's really all there is. We're going to think of the net exports in net, how much Yoon imports from Linda as being connected to the exchange rate. Okay, so it's a very, very simple view of the world. It's going to pin down interest rates. We don't really have to think about that much. It's just Yoon is thinking about consuming today versus tomorrow. If all else equal, if interest rates are very high, that's going to affect his trade-off between today and tomorrow. Okay, but we're not going to focus on that for today. Now, the part that we have to focus about is the lovely financiers, Laura. Laura is going to sit between Linda and Yoon and is going to say, look, these people are trying to trade with each other, they're trying to borrow and lend, and they're not going to match. On average, it's not as if every time Yoon wants to sell dollars, Linda wants to buy dollars. Somebody has to absorb the mismatch. And that's really the role of global financial institutions. A place like Goldman or PIMCO, it's this equation over here, and let's figure out what it says. It's something very intuitive. It says that on average, they want to make money. So to convince them to hold the position, in this case, Q is how many dollars they own versus yen, they have to make money. How do they make money? Well, either through the interest rate differential or because they forecast that the exchange rate will go in their favor, at least on average. Now, the whole imperfection is in this parameter 1 over gamma. The way to think about this is that if gamma is extremely high, if gamma goes to infinity, Laura is so afraid of taking any risk that you could give her almost any pattern of the exchange rate and she will not absorb any of the risk. At the other end, if gamma is 0, Laura is at the opposite extreme. She's risk neutral. She'll be willing to absorb any imbalance of trade for any positive return. And so the only equilibrium can be there is no return. Now, if this sounds a little bit crazy to you, these are actually two of the most classic benchmarks that we use in economics. The second one, when gamma is equal to 0, is what is called UIP. Most traditional macro models impose that one. They say that currencies are going to provide no excess returns whatsoever. And as you will figure out in a second, the foundation of those models tend to imply that FX intervention is just useless. It doesn't have any impact whatsoever. At the opposite end of the extreme, gamma infinity is financial autarky. So when we impose sanctions, when we restrict trade, when countries don't have financial markets, that's where they are. And you can see that the exchange rate in equilibrium varies with the level of gamma. It could be almost anywhere, which has to do with the exchange rate disconnect. Now, let's get into action. What do flows do in this policy framework? So the thing that is useful, the thing that this model is useful for is to think about the example of Yoon wakes up one morning. Actually, in this case, I need to pick up Linda. Linda picks up one morning in Japan, and she really wants to get hold of dollars. She learned that there is a pandemic, the dollar is a safe asset, and she really wants dollar bonds. And we're going to model it as she has a demand F star for dollars. So she's approaching the global financial system, and she's saying, I want to hold dollars, I want to sell yen. In a lot of models, in particular, when gamma is equal to 0, this has no effect. Why? Because the financial intermediaries are so happy to take the other side that nothing has to impact exchange rate. There's no pressure. They simply take the other side and the exchange rates are unchanged. You can see it formally here if I set gamma to 0. If markets are perfect, that's also the same. Because in some sense, that trade can be unwound if it's just purely noise. Although one has to be a little bit more careful about that statement. So this model gives you a very simple rendition of there is price pressure. If the world is demanding a currency, it tends to appreciate because of imperfections in the financial system. Once you have this simple framework in mind, then FX intervention becomes an interesting policy. And let's figure it out. Suppose that we do two things. One is we study a flow that is simply the central bank intervening. Okay? Here, Japan buys dollars. But also, we're going to introduce sticky prices. Now, many of you are familiar with this, but if you aren't, listen to me for 2 seconds and I'll explain it to you. Why do we like sticky prices? One, because they're a feature of life. Prices tend to be sticky in some currency. They don't vary with the exchange rate all the time. But two, because they control for the exchange rate. If I'm Italian, if I'm an exporter of Italian goods and my prices are constant in euros, when the euro depreciates versus foreign currency, my will go up. So it gives a very simple reason why there is an impact in the economy of a movement of the currency. Okay, and that's essentially what we're going to assume here. So the first thing to figure out is that intervention in this model is just like the flow we discussed before. It's exactly identical to a private flow. It impacts the market because you're impacting the balance sheet of a constrained intermediary. When Switzerland is intervening, what they're doing is they're taking away positions from the private institutions, from Credit Suisse, from UBS, and they're relaxing their financial constraints. And that, okay, so it's just the duality of the private market. There isn't a particularly special role of the government other than that. Now, once you know it makes an effect, you can ask, and should we use it optimally? And here I'm going to give you just a proof of concept more than a real analysis. The way to think about this is that two things matter, and I'm going to turn to this. One is the extent to which the markets are imperfect. You can see that how much do you move the exchange rate for a given intervention is inversely proportional to how integrated the markets are. The way to think about this is if you're facing a very integrated market where all the financiers have lots of capacity, it takes an immense amount of intervention before you move the exchange rate. If you're intervening in euro-dollar, there's a very big market. It will take a lot of intervention in quantities to move the exchange rate. But if you're in a crisis or you're intervening in a relatively illiquid market with low segmentation, much smaller interventions will move the exchange rate. That's one thing. So it tells you that it's a policy that works best in terms of not having to buy too much when markets are not functioning properly in crisis, or in economies with shallow markets. Second, and is more of a welfare part, is you tend to use it when your output is way below potential. When the currency, for example, is too strong, you're not competitive, you're way below potential, and if you intervene and depreciate the currency, you will boost the economy. How does that work in our mind? It's pretty simple. It's saying, look, interventions will have some cost. In particular, it will distort some margins, both across states and across time of the economy. But the output boom, if you're really deep into a bust, it's so big that it will swamp almost anything else in terms of welfare. That's the way we think of the logic. It's just a very simple rendition of a policy prescription that, again, emerging economies have been arguing for a while, but I think we try to give it some theoretical content. Okay, that's it for the equations, okay? So if I haven't lost you yet, we're in good shape, because the rest is going to be just thinking about these policies and big pictures. First, I want to, theory is useful because it makes you think about, little details that end up being important in practice. One that I think I've learned to think into this logic is that intervention is really best thought of as a swap. It's like, I take a private institution, I say, you're stuck with this position, and that's putting pressure on the market. I'm going to take it on my balance sheet as a central bank because I'm much more relaxed to take the risk. Why does that matter? It matters because it means that there is much less of a role for reserves. Traditionally, the way people thought about interventions is that, for example, if you want to sell foreign currency, you need to have acquired the bonds beforehand to be able to sell them. That's actually not the way I would think about this, because suppose that you have no foreign bonds to sell. What you do is you just do forwards, you do derivatives. None of that requires having the asset beforehand. And yet, I think from a theoretical perspective, once you think about it's about the transfer of risk, they work just the same. And so that one, I think it's part of the reason why intervention now is done so much through derivatives. It also says that perhaps the more interesting concept is not the amount of reserves that the central bank has, but it's fiscal capacity. When you do intervention, you might lose money. And the credibility of the intervention is somewhat related to how much are you going to be able to sustain those losses before, for example, the government intervenes or you lose you lose independence. So it really is about the ability to absorb losses, I would think. I mentioned that how strong is the intervention depends on the state of the market. The more the markets are segmented, the more you get a bang for your buck from intervening. I would also say that it has a very similar foundation of quantitative easing. I mean, you must have noticed that almost everything that I said about segmentation, how it works, has a strong duality with the reasons we think quantitative easing works domestically. So the two policies aren't that distinct in terms of their theoretical foundations. It's very difficult to believe that one works and the other one doesn't, and vice versa. You might believe that both don't work, and that's fine. But again, theory puts a little bit of a straitjacket on what it is that are plausible opinions. It also has lots of relationship with other policies. One that I want to mention is capital controls. I think of these policies largely as complements. Why? Because what capital controls, in my view, does is that it kind of segments the market. It gives you an average level of segmentation. And then affects intervention around that one, so it smooths the movement in the exchange rate. Now, some countries don't use them together. Switzerland, for example, I believe has imposed no capital controls, but intervene a lot. But a lot of countries prefer to first impose some capital controls, segment the market, and then intervene. And the way I rationalize that through the framework is it makes it much more powerful as an intervention if you increase the segmentation to begin with. It doesn't force you to buy quite as much to achieve the same outcome on the exchange rate. What does the data really say? So that's difficult to address. Here's my own personal views. And I have to stress, this is really my reading of the literature. So one can very reasonably disagree. First, I would say that recently, compared to the old literature, we found a lot more successful interventions. Part of the reason is they've been much bigger. I mean, I showed you Switzerland, Israel, they've been on a completely different scale from what we'd seen before. But I would say that if I take a very empiricist approach to it, the main elephant in the room is endogeneity, which has gone still largely unaddressed. And so my view is that so far we have little or no hard evidence. I wouldn't sort of draw very strong conclusions on policy evaluations. That is not to say that the evidence we have is bad. It's just more to say that we haven't quite figured out even how to compare. For example, what is an intervention? If you're intervening by doing, a few $1 million, a few small things, that's unlikely to have an effect even in these models. If you're buying 100% of your GDP in foreign currency, that's a whole different scale. And in that sense, we're at a disadvantage with the QE literature, because QE has been a much more well-defined event, is the central bank buying an immense amount of assets. And so we all focus on the same event. With FX intervention, as you compare across papers, some people are looking at very small interventions, some people are looking at very big ones, some people are looking at high frequency, some people are looking at over 2 years. And so it's not so obvious to me how to put it all together. It's also not obvious what the target is. I mean, in the model I showed you, the target is the level of the exchange rate. But in a lot of cases, the target is more the volatility than it is the level. And so it's not even obvious how to measure success. So given that, I have the attention of some of the governors here, this is a call and a plea for very serious policy evaluation. I mean, the central banks are taking major risks. We are doing this in staggering sizes. We would like to have, precise answers, better than the ones I gave you. And that really requires more access to data, some form of, randomization. I mean, clearly, we're not going to randomize billions, but some form of identification for the policy to address endogeneity. And so I would like to sort of point out that hasn't quite happened yet. And, the central banks and the BIS should be hopefully a big part of getting it done. I'm going to conclude very briefly because I think I'm almost out of time. I want to tell you a few other things that we don't know yet. One is the revenue extraction motive and the political economy. So one of the reasons why in the past we've opposed, as economists, FX intervention and capital controls is they can get abused. In principle, I think of FX intervention as less likely to be abused than capital controls. Capital controls are a tax. You're going to make money. That might be bad for the economy, but they're going to generate positive revenue for the government. FX intervention is a trade. You might make money, you might lose money. So you might be a lot more hesitant to use it if all you want to do is just appropriate resources. Who should govern these policies? Should this be the central bank? Should this be the treasury? So far, it's been the central banks. But what if the central banks make massive losses? Then it becomes a fiscal issue. And do we really want the central banks to do this and cause a massive loss for the treasury? How do we want to think about this? Maybe we ought to rethink a little bit where the boundary is, particularly to protect the independence of central banks. Should we look, in the literature, there's a sense that because you're intervening against the market, FX intervention tends to lose money on average. I'm not so sure that it's true because the markets can be wrong. Markets can have very biased expectations. And so taking the other side might be profitable. We don't know yet. I showed you 2 cases of using floors together with interventions. Is that a good or a bad idea? Theory has something to say about that. Floors make the market very one-sided. And so I view them as generally bad ideas because they give the market a trade that is very attractive if they can break you. And but they have been used very heavily by both Switzerland and the Czech Republic, although I suspect not as successfully. And then, of course, today, the news are full of accusations of currency manipulation. There's a question of whether the policy is a beggar thy neighbor policy. I can give you the answer in the confines of this model, which I'm not sure, it's the ultimate answer. But it doesn't have to be. It really depends on the relative situation of the 2 countries. For example, in this model, if one country is in a depression, its output is way below potential, and the other one is doing well, and the country that is in the depression intervenes, it's actually a net positive for both countries. If they're both in a depression, then it is a beggar thy neighbor policy. If one country intervenes, its GDP go up, but the other one goes down. So you really have to think of it as in the circumstances and what is happening more than as a general, these policies are beggar thy neighbor or not. Let me just stop. I want to leave on the screen. There's a lot of active work in this literature, including the BIS. I showed you the annual report. There is theoretical work. The IMF is working on it. I just showed you a very first pass at a high level. There's a lot more that has been done and we still need to do. So I think of it as an exciting area. Thank you so much.
Well, thank you, Matteo. Thank you for that very good presentation. I think you've given us a lot of food for thought, and it's also good to see engagement with the policy literature as well. You very kindly cited our annual economic report from last year. One of the things that was said in that chapter was that the theory has to catch up with the practice, and I think you've contributed a lot to that, to that endeavor. Let me turn to our first discussant. Let me see if we can move the ball to our first discussant. Our first discussant is Linda Tesar from the University of Michigan. It's great to have you, Linda. Let's see if we can get going. Linda, the floor is yours.
Great. I guess if the screen is shared with me, I will put up my slides. Here we go. Okay, can everybody see the slides? Great. Well, I want to thank you so much for this opportunity to discuss Matteo's presentation. He did a great job of laying out the theory. And I guess what I want to do is maybe I can answer his plea for a little bit of more attention to data. So that's where my discussion is going to go. I think this has been a great advancement of our understanding of FX intervention policies. And what Matteo and Javier's work does is they place the financiers at the center of these global financial transactions. And as he very, well explained, what happens here is that these financiers get hit with shocks that come in, capital flows in and out. They're trying to manage portfolios, and therefore they have to absorb these differences in the denomination of different assets. And the exchange rate then is going to adjust depending upon the willingness or the ability or the capacity of this sector of the economy to bear the risk that comes from holding different portfolios. And the contribution of doing this is that it has really helped us by putting the financial sector sort of at the center of where all these transactions occur. Is it helps us understand a bit more of the exchange rate disconnect. I mean, for decades now, we've been grappling with trying to understand why it is that the exchange rate can move so much, and yet it seems to have little bearing on the real side of the economy. And we've known, I think, for a long time that financial flows are important, but really having a theory that helps bring the financial sector as the centerpiece of the model and then deliver this result that we have this disconnect between real variables and this very important price is a huge advancement. It also, in so doing, introduces this role for intervention, because in a world with financial market imperfections and this externality that comes from this financial sector responding to these capital flows, we now have a role for the central bank to step in and helping offset or helping absorb these exchange rate movements. So the theory suggests that these interventions then can play a role in affecting real economic activity. And it also suggests that these interventions operate through the financial markets and may not have a direct impact on trade. So this leads to the question, and Matteo posed it, there's growing work on this and people thinking about it, and clearly practice as interventions are actually occurring out there. So the question is, do interventions have real effects? And I want to suggest to you, based on a bit of work that I've done with a couple of co-authors, that the evidence from the Czech Republic suggests that perhaps yes. And I see we have someone here from the Czech Republic. So to the extent I get details wrong, we have an expert in the room who can correct me. So as Matteo mentioned, the Czech Republic maintained an exchange rate floor from late 2013 through April 2017. So essentially a policy of maintaining a weak kroner, if you will. It was a one-sided commitment. The concern was deflation and exchange rate appreciation. So there was sort of a one-time depreciation and then a maintenance of this floor, which, as Matteo showed, didn't need much intervention at the early stages, and then in the later stages did. So what I want to talk about is, it is hard. It's a challenge to evaluate, did the policy work, or what effects, what real impact did this have on the economy? So we do two things. I don't want to suggest that either is perfect, but they are suggestive. So one is to create kind of a synthetic country that looks like key features of the Czech Republic prior to the intervention, and then ask, if we use that as a control, how did the Czech Republic look or move differently from this kind of synthetic country that we've created? And essentially it's a weighted average of other European countries, taking into account how much they trade, what does their GDP look like, so different features, but weighting to kind of create this pseudo twin to the Czech Republic. The other is to gauge the performance of the Czech economy relative to what was the forecast coming from the central bank prior to the exchange rate intervention. So again, you already saw this picture, but here is the Czech exchange rate. And you can see period here of the intervention. And you can see this period here when the Financial Times dubbed the Czech kroner as the world's most boring currency because it didn't move around much at all. So here we show the comparison of the Czech economy. This between the dotted lines is the period of the exchange rate intervention, or the maintenance of this floor. And what you see is the blue line is the Czech path for real GDP, and that's against this what we call the doppelganger, or its fake twin. And we've got a standard error band around that alternative comparison economy. And over here on the right, we're just showing the difference between these two lines and the standard error band. And what you see is that it sure looks like real GDP moved high relative. So we see an increase in real GDP relative to this control group during this period of the exchange rate floor. We also look at unemployment, and you can see that unemployment improves in the Czech economy, again, relative to its twin. And here again, the difference shows that it's well outside of the standard error. What's interesting, though, is when you look at trade, and again, this is, I think, consistent in kind of a broad way with the theory that Matteo and his co-authors have laid out, that intervention isn't really operating here through trade. So here you see when you compare Czech exports relative to this other economy, they don't seem to depart ways. And the same thing is true on imports. So this suggests that it is working through this financial sector operating through interest rates and relative prices within the economy, but is not seeming to affect trade flows. And similarly, if we compare performance of the Czech economy relative to the pre-intervention forecast, you see again, the forecast was to have rising unemployment, and what we see instead is declining unemployment. And we see GDP increasing relative to forecast. So I don't want to oversell this as evidence, but I think it's suggestive, and maybe this is, at least some empirical support for the theories that Matteo has laid out. So just to sum up, it does appear that the intervention in the Czech on the Czech kroner had real effects that don't seem to be working through the trade balance. This is consistent with segmented financial markets and euro pricing. And I should say that this empirical work was done in conjunction with my colleagues Christian Probsting and Chris House. And I guess this is the season. Christian is on the job market. So if you're looking to hire a really excellent economist, I highly recommend Christian to you. I do think, just to kind of conclude, this is provocative. This certainly brings a new instrument into the central bank toolkit. I do think more work needs to be done, a lot more discussion needs to be done, and some of that will likely happen today on, when is it wise to use this tool, and when is it maybe not so wise? And Matteo mentioned some of these factors. When it's a country-specific, particular case, the argument can be made that FX intervention may be an important thing to have in the toolkit. Not so obvious if we have disturbances that are global, then we get into problems of beggar thy neighbor and countries playing off of each other. So that's an issue. It's also the case that both the Swiss case and the Czech case were cases of capital inflows and pressure on exchange rate appreciation. And I think, a different set of arguments will come in, and maybe Lara will talk about some of these, when the intervention is on the other side, and when instead of accumulating foreign reserves, one is actually depleting reserves to defend the exchange rate. And I think that is a different set of, and these are familiar arguments about, how long can one and should one intervene in those circumstances. And I think that raises the question, is this a policy that works well in advanced economies like the Czech Republic, Israel, but maybe less so in emerging markets where maybe concerns about volatility and there are more issues of financial fragility? Maybe this is not such a good tool to be using. So I'll stop there. Thank you so much.
Thank you very much, Linda, for that very stimulating discussion. Let me now turn to our second discussant, Lara Alfaro from Harvard Business School. Lara, the floor is yours. Go ahead.
Thanks. Hello?
Carmen.
Hello? Yes.
Okay, good. Go ahead, Lara.
Thanks, the organizers, for inviting me to comment this paper. It would have been great to be in beautiful Switzerland, hopefully next time. Matteo discussed with us the application of his beautiful paper with Gabe on the role of FX intervention in a setup that has imperfect financial markets. I won't get deep into the paper. I recommend, when you have time, it's a clever, simple, beautiful, elegant paper, but it has every possible extension you can think of, either as you go through the paper in a footnote or in appendix. Again, I'll leave it to you to just enjoy over the holiday season this beautiful paper. I want to concentrate perhaps on some thoughts on effectiveness and the time frame of this effectiveness, and I'm going to draw on a discussion that I did of work that was done by the IMF Western Hem folks, Tamon, Hoffman, Magud, and Werner, who analyzed foreign exchange intervention in a subset of Latin American countries. And I'm going to talk a little bit about the role of other policies and the interaction of other policies. So let me start by justifying why Latin America, as it was not mentioned in any of the examples as a beautiful Czech Republic, beautiful Israel. I would argue that Latin America has a lot potentially that we can learn from this because of our rich background. Matteo mentioned that if you're an economist recently, you have seen the global financial crisis, the European crisis, and now the pandemic. If you're from Latin America, you grew with crisis. We had the debt crisis of the 80s, we had the tequila in the 90s, we had Argentina, Brazil in the 90s, and so on and so forth. So we have had many exchange rate regimes and many sort of crises. But as Latin America has grown up, I also would argue that it's very interesting because it has very different backgrounds. It has different degrees of trade and financial integration from Mexico, that is very exposed to the US, as you go south, that is relatively less and more diversified, like Brazil. You have different cases of dollarization, countries like Peru and Uruguay that are very dollarized, or cases that Brazil, that if you go and try to pay anything in dollars in Brazil, people don't take it. It has very different degrees of financial development. So Brazil and Mexico have very sophisticated financial markets. I think people don't give them credit, the type of things you can do in Brazil and Mexico in terms of exchange rate intervention, derivatives, and also complex instruments versus, for example, my own country, Costa Rica, that is very basic. It has also had different types of interventions. Again, as Matteo has mentioned, many countries do use swaps, others just go and intervene in the spot. Different degrees of transparency as well. Different commitments to inflation targeting. I know people are now not talking about inflation, but I would take this as a proxy of credibility serious institutions, like, for example, Chile versus my own country, where the credibility of the current administration is iffy, and also different levels of fiscal space. So you have Chile and Peru that have a lot of fiscal space versus others that do not. And I would argue that perhaps the model that Matteo presented maybe speaks of the first four a little bit more than perhaps the last two. In this book, they mentioned four different motives to intervene. One is accumulate reserves just for precautionary reasons, attenuate fiscal risks. There are others related to try to manage inflation or manage more persistent shocks. Again, some idea of competitiveness. I would argue that Matteo's paper is about these welfare effects under imperfect financial markets, which in a way do speak of, again, the first two, but this is not per se a crisis paper, or is a crisis of certain type that does come from changes in the risk aversion of the financiers. It's per se not perhaps a domestic crisis, or as Linda mentioned, a global crisis, or even the pandemic that does have a fundamental. The paper would argue for targeting a level, and I would say over a medium long-term range, as the paper does say, is not about high frequency. And here I want to say that countries have managed to maintain fixed exchange rate regimes, and they have managed to maintain fixed exchange rate regimes over long periods of time. So it's not that we don't have evidence that this can be done. And in fact, the IMF was created precisely for that, to help countries maintain a fixed exchange rate regime. And these always involve some forms of intervention. But I think that the paper is not really also about this idea of maintaining a fixed exchange rate. So the book does mention effectiveness of targeting a level and volatility. As Matteo mentioned, is extremely open about the fact that there might be identification issues. And again, it is what it is. We're not going to randomize interventions. I would be the first one to sue my country if it's part of some randomized intervention to see what happens. And so as economists and practitioners, this is the world we have, and we just have to try to make the best sense of it. I do want to mention that there is a bias in the literature. It's hard to publish non-results. And there might be good reasons, but one also needs to keep that in mind. And reading the evidence, the results vary. I would say, if anything, they're more negative than positive. It's extremely hard to target a level. Some of the papers find durations very limited, 90 minutes. At best, some find 1 week. Again, the counterfactual is very hard. In terms of volatility also, some do find that it increases. A nice interpretation of this is that many times there are conflicted objectives, and this does lead to an increase in volatility. And some of the evidence does suggest that the pre-announcement makes a big role, and so there might be a call that this is signaling other policies, interest rate policy, monetary policy, or some form of fiscal change. Israel did intervene, but they also did change the exchange rate. So again, it's hard to disentangle the effects of some of these policy. Just very quickly, Uruguay, the effects, if anything, short-lived. They don't find more than a week, and they do find increase in volatility. The case from Mexico, 20 years of experience, it's very hard to target a level. They do argue that if you're going to use them when really necessary, and I call in the paper for transparency. Case of Chile, again, they find short-lived effects. Chile is a case, as Linda mentioned, that finds differences when you're trying to prevent appreciation versus when you're trying to prevent depreciations. And again, a call, if you're going to use them, really use them in extraordinary circumstances, which, again, we have lived in that world. Other effects, the case of Costa Rica does show that when you start using these a lot, you diminish the incentives for the private sector to internalize exchange rate risk, and that actually increases your financial vulnerability, but also affects the pass-through. Again, associated with this, that there's no commitment, or if anything, people know that the central bank is going to affect the exchange rate. One interesting thing about Latin America in the 2000s, and that there was very few, if any, cases of homegrown crisis except Brazil. The book does not cover Argentina and Venezuela. Brazil in the 2000s had the worst recession in its history. That recession is actually going to be worse than the pandemic recession. And it was associated with this world of precisely using capital controls, heavily managing the exchange rate, and loose fiscal policy, apart from corruption and some other issues. But this was a world where Brazil anchored exchange rate inflation expectations, again, a proxy of credibility. And then when they were trying to solve the issue, the central bank had to maintain higher interest rates, perhaps for longer. And eventually, Ilan did a great job in managing this economy. One thought on the model. This is a model that does not look into the role of fiscal spending. I have seen that this is a new, if you want, in vogue. All of these models advocating exchange rate intervention and capital controls just get rid of the fiscal. But most countries' government spending is heavily biased on non-tradables, so it is possible that you can get the same just by changing government spending. And if anything, in this model, perhaps this is why a lot of the central bank intervention does look like a fiscal intervention because of that type of interventions. And again, some fiscal vulnerabilities, if they're reduced in bad times, that does give us more space to act in. If they're reduced in good times, give us more space in bad times, something that Latin America is suffering right now. The other, and again, just a word of caution, we're taking the financiers, the risk-bearing capacity as exogenous, but the development of the financial markets is endogenous. In some paper that I'm doing with Mauricio Calani from the Central Bank of Chile and Liliana Varela, we're looking at the development of the foreign exchange rate market in Chile. And you do see here that moving to more flexible exchange rate in a country with no interventions in terms of capital controls and very much credibility has helped the country develop this market. And it's an interesting construct with Peru. These two countries have very good, if you want, fiscal. And so again, it does seem that all of these policies are related. And if we want to have better financial markets, and if better financial markets do allow us to deal with those vulnerabilities, we do have to think about the interaction of all of these policies. But a great paper, great timing. Again, it's all over the news, these interventions in the foreign exchange market. Theory is important to help us understand the potential effects, and we just have to be clever how to evaluate policy and this interaction of policies. Thanks.
Thank you very much, Laura. So together with Linda's discussion, I think we have a very rich menu of topics to go through. Let me now open the floor for questions or comments from the participants here in the session. If you could indicate your intention to intervene by raising a hand, or if I can see you on the camera, just raising your real hand would also be an option as well. And while you're looking for the raising of the hands button, perhaps I can also just add to the discussant's comments, Matteo. This parameter gamma seems to be playing a very important role. It's a kind of catch-all that encapsulates all the different ways that you could have a deviation from uncovered interest parity, some kind of financial constraint. It could even be some kind of value at risk constraint. What I neglected to mention was that actually in his earlier career, Matteo was also a currency trader. So Matteo understands these constraints very well. So tell us a bit more about the gamma and how you interpret it, and if you have any reactions to the discussant's comment, that would also be very helpful. And
absolutely,
meanwhile, I will look for the buttons that are going up. Matteo.
Absolutely. First, let me thank both Linda and Laura for the comments. These were great comments. I think they gave hopefully the audience a full spectrum of how we think about these policies, how much work there is still to do, when are they successful, when they're not successful, under which conditions we even think theoretically there might be a good idea or a bad idea. And so I think it's the one thing that I think most of us have a consensus on is it's a bad idea to think of these policies as always the same, always and everywhere. Even in the models, you can see that it really depends under which circumstances you get an outcome and not. And so one has to have a deeper understanding. I want to touch on two things. One is on the question on gamma, which also I think Laura touched on. I think I'm going to answer at two levels. At a very big level, which is really the one that matters. These models are trying to tell a story. And the way we model the constraints is always infinitely more reduced forms than what they are in practice. And so I wouldn't take, we have these stealing constraints in economics, which are very tractable. They give us something that, it's very easy to analyze. They're not necessarily what we really mean deep down. Clearly, the constraints in practice are much more complex. I think Yoon mentioned VR constraints, which I like a lot. He's worked heavily on those also on a theory perspective, because they are closer to the practice. And here it wouldn't make much of a difference if we flip one for another, at least at the high level. So I think you really want to think of it as it's just a core message of a limit to financial risk-taking, and not so much exactly how we do it. A lot of it is, what makes it beautiful and simple is also what makes it, a little bit too Mickey Mouse if you take it very seriously. On the other hand, on the gamma being endogenous, that's actually an interesting thing. Both in the short and in the long run. I would say in the long run, there's lots of financial development that I'm not going to get into. But I think one of the interesting extensions of this framework that has been worked out by a number of people, I believe including us, but at this point, I'm not even sure. But the economics is very simple. If the central bank intervenes and it makes it one-sided, it makes it very attractive to take the other side because everybody understands that you can't lose much money, then what happens is that the gamma shrinks. Why? Because a lot of money floods the market. PIMCO, that never even traded this market, all of a sudden decides to enter because it's such a one-sided bet. And so you have to be really careful in how you intervene in not making the market fight you too much. If you make it too obvious that it's a one-way trade, then in these models, it's as if you were lowering the gamma. A lot of money comes in to intermediate because it's profitable to do so. And so I think that speaks also to what Laura mentioned. The last thing that I will talk about is something I mentioned in the talk, but I think both Laura and Linda really exemplified it very well, which is there is no consensus of what even an intervention is. So when you're trying to look at empirical studies for outcomes, it's very difficult. To me, when Laura mentioned the 90 minutes, the interventions I have in mind, it will take several days for the governments to even go through the buying process. So the 90 minutes is just almost like they must be looking at a very small trade. Switzerland, it takes a year of intervening to get there. It's just a different time frame. I think what Linda had in mind with the Czech Republic, these are like in billions. It will take weeks and time to even get into the position of the government. On the other hand, you can do very tactical interventions, on a given day. But I think they're probably loading on very different mechanisms. And that's why I think the empirical literature and the comparison, it's so difficult to do. For QE, it's a little bit more obvious because we mean the big events. We mean QE1, QE2, and there's a bit of a focus in the literature on those events. For FX interventions, a bit scattered all over the place. And I wouldn't think of them as similar interventions. I think of them as quite different even from what it is that one tests. But we're not there yet. And I think Laura is correct that even today, when you look at a lot of the policy evaluations, it's not obvious that you find a ton of success, particularly for the smaller interventions. For the bigger ones, you do. But then again, nobody doubts that if you really want to, as a developed country, you can move the exchange rate. You can fix it. Maybe it's a combination of policies where FX intervention is just one of them, and disentangling the effect is difficult. So let me stop here, and hopefully that gave you a bit of a sense.
Great, thank you, Matteo. So we have now indications of interest to take part in this discussion from Linda Goldberg and from Benoit Maujean. Timon, could you give Linda Goldberg the microphone? I think Linda can just unmute herself, right? Linda, can you try unmuting yourself and just coming in?
Yes, can you hear me?
Yes, we can.
Okay,
Great.
So thank you, everyone, for these excellent presentations. Matteo, I just want to follow up on the points that you were just making about the quantitative impact of interventions. And if you had to give guidance on the things that would enter into an elasticity of response of exchange rates relative to an appropriately defined benchmark of where they would be absent the intervention, so that's Linda Tesar's kind of comparables, what would be the factors specifically that would come into play in understanding the effectiveness of that foreign exchange intervention on exchange rates?
That's a very interesting question. So, suppose that we took more of a structural sort of model to the data. So we said, look, we're not going to be able to identify it in terms of reduced form, but we're going to take a structural model and what elements do we need to see their interaction to try to back out the deep parameters of the model. I would say a couple of things. One is you need to be able to see the positions in the private market, and that's a difficult one. So, for example, through the Global Capital Allocation Project, I've done a lot of work on asset managers, but it tends to be the cash positions, as in bonds, and not so much the derivatives. A lot of these markets might be in the derivatives, which is less observable, although again, the data is getting better through, for example, the data repositories and through even a big effort of the BIS on collecting more derivatives data. Then you have to see the structure of the market. In some sense, you want a measure of this gamma. You want to know how constrained are the big players. So you need to know who's regularly in that market, and how big they are, and what are their current exposures. Are they already stuffed with these positions and they are, in Yoon's phrase, at their VAR limits, or they're very, very far away from that? You need to think a little bit about Laura's question, which is maybe there is a problem when once we start intervening, new players that are normally not intermediating in this market will appear. And they might be very big. You might draw in, even if you're a small market, one of the big fund houses. And then, of course, you have to think about the central bank. You have to think about what's your plan. How much of this can you withstand? If there are losses, how many can you absorb before the pressure becomes too much and you have to give up? I hope that for many of you in this room who are policymakers, this sounds like the kind of analysis that you would do anyway. And I think Yoon is correct. We're sort of catching up to that and trying to figure out how to put it into models and put more structure around it. But I think that those are to me what, based on what I know, what I would be looking at. There is an open question: how much of this can we observe carefully in the data? And that's what I was making a plea for more and more transparency on this. I'm with Laura that we might not be able to randomize, but if governments are going to spend 100% of their GDP accumulating reserves, that is a pretty expensive policy if it's wrong. So investing some money and some effort into figuring out whether we are doing something that is welfare improving seems worthwhile, because we are doing it on a grand scale. So we are taking a stand, at least as a sort of, not me individually, but as an economics profession. And we better know more about this. I think it's a very, by the way, let me just say one thing. I think there is a lot of progress right now in the literature, in economics, trying to take those structural models to the data and invert them into deep parameters of the demand functions, I think FX intervention is probably one of the best applications that I could think for those approaches.
Great. Let me now turn to Benoit Maujean. Benoit?
Yes, so I'd like to thank you three for brilliant presentations. So a question to Matteo. I remember the 70s and 80s when the type of adjustment that we saw where you had countries, especially in Europe, I'm thinking of some countries in Europe, that had low inflation, but ongoing appreciation of the currency vis-a-vis the trade partners. And now we've moved the last 20 years in a situation where you have low inflation everywhere, fixed exchange rate, but something's got to give. So you see these countries accumulating ever-growing net foreign asset position on the rest of the world. And in some cases, the central bank is participating to this accumulation. And so I'm wondering whether you have a sense on what is the long-term trade-off and why those countries seem to prefer having this accumulation of a net foreign asset position at this rhythm rather than seeing an appreciation of that can be in real terms, letting wages increase more at home, even if you want to keep the exchange rate. So what goes into this evaluation of the different policy options, and what leads them to prefer accumulating faster this net foreign asset position versus letting the currency appreciate in real terms? You may want to keep the nominal exchange rate, but you can still let domestic prices increase faster. You can increase wages and so on and so forth.
Perfect. Thank you for the question. I think I should also involve Linda and Laura, since they've also worked very heavily on related topics. This one, I'm going to take it a little bit away from the specifics of the models that we were discussing. I think in general, there's been an open question on why people want to accumulate reserves, why countries want to accumulate reserves. And there are some, big theories out there that have to do with either, precautionary motives where you try to have liquidity. I have to say that reserves have become so big that those models might struggle quantitatively sort of justifying such level of reserves. Covering a crisis, doesn't quite require that level, or at least, one might need to stretch it to get there. There is certainly some form of empire building. Where governments are in control of these reserves, they get to allocate them. For China, we see now in the news all the time part of the effect of spreading those allocations around the world, and there might be reaching political incentives that aren't core to the way we think of normally FX reserves. There is certainly the motive of the exchange rate. There is where I think I can bring it back a tiny bit more towards what we were discussing today, which is if you think of an intervention where you're trying to prevent appreciation, you're selling domestic currency and buying foreign currency. So if I think of the Krugman models of the 70s, there should be no limit to this. I can always print my own currency, give it to you, it costs me nothing, and I buy foreign assets which have a real value. Where does the limit come in? Well, I think there's two things. One is you might not do it forever, and if you stop, like Switzerland, you let the sort of floor go, there are losses because your currency might appreciate and you suffer losses. You might say there are paper losses and the central bank can always print, but then that brings you to your argument. At some point, it has to show up in inflation. At some point, it has to go there one way or another. And that's really what you must have in mind in the long run of the cost of that side. The other side is more traditional. I'm trying to sell foreign currency. At some point, I run out of it. Now, as I mentioned, it's not quite as bad as it was traditionally. You can sell derivatives if you have fiscal capacity, but there is certainly a difference. You can't print those bonds. But let me stop, and really, I think Laura and Linda, I'm sure, have insights on this coming from their own work.
Yes, Linda and Laura, please go ahead. You have the final word.
Yes, just to echo what Matteo was saying, indeed, a lot of the models that have tried to quantitatively justify the level we have seen of exchange rate accumulation do suggest that this has been beyond anything that has been precautionary. There seems to be some other motive. And here, I would argue that a lot has been this political economy of this competitiveness, exchange rate appreciation, exporters, importers, underweight. If you look, for example, the experience of Chile in the 90s, there was a lot of exchange rate, there was a lot of pressure of appreciation. And this is the period where Chile started to accumulate, but the central bank was facing losses. There is the interest rate differential, but then we're also seeing inflation. This is also the period where they started to put capital control. So again, there was a huge political economy behind trying to maintain that exchange rate from appreciating. The same case is China. Usually you do see a lot of this political economy. On the other side, we all know it's harder. I would caution a little bit on the ability of swaps and derivatives to be able to do this, especially on the depreciation side. We do know from the Asian crisis that many countries were using these derivatives, and then we went and checked, and it turns out that they didn't have the reserves to pay. And I think Malaysia was this case. A little bit of this may be going on in Turkey. There's some concern that they sold a lot of reserves against this, what they have. So there is a limit, even if they can use derivatives. So the evidence does find that it is asymmetric. Appreciations are not the same as depreciations.
I would add just one small thing, that it's interesting that we've gotten this far in this conversation and the word credibility hasn't really come up, and it's here, right? Like what is the price tag of credibility? How much do you need in the bank to have the credibility to support a particular exchange rate target? And this is where we get beyond simple economics and a little bit into expectations and other kinds of modeling and thinking.
Well, thank you very much for all your great contributions. I'm looking at the clock. Sadly, we've run out of time. We could have gone on for much longer. I'm just thinking back to the first webinar of our series when we had Ricardo Reis talk about the big macro questions, R minus G, and how exchange rates and inflation pass through all factor into the big policy questions of the day. This is something that we didn't explore, but it figured in some of your slides actually that it was pointing in that direction as well. So there's no doubt that these issues to do with exchange rates, they've now come back very much to the center of our attention. So thank you, Matteo. Thank you, Laura. Thank you, Linda, for your great contributions to this debate, and thank you all the other participants, especially from the central banks, and to all those watching on YouTube. So let's close the session here, and we very much look forward to seeing everyone, hopefully physically next year. To see everyone, hopefully.